Welcome back to Talk Tickers. This is the place where we skip the fluff, we ignore the PR spin, and we get straight to the numbers that actually move the needle.
And I'm here to help connect the dots. It's good to be back.
Today we are turning our eyes south, well, mostly south, but, increasingly global. We're looking at Patria Investments, ticker symbol PAX.
Yep. They just reported their Q4 and full year 2025 earnings yesterday, February 3rd.
And let me tell you, if you're watching the tape, it was a bit of a roller coaster.
It certainly was. We often talk about sell the news events, and this felt like a textbook example.
Exactly. So picture this. The report drops. The numbers look good. Better than good in some spots.
Okay.
The stock pops in pre-market, trading up around, 1543?
Right.
The bell rings, market opens, and thud. It just faded all day long. Closed down over 7% at 1427.
And the volume was double the average. So people were rushing for the exits despite what looked like a solid print.
That is the big question we need to answer today. Why the sell-off? Because on paper, they delivered.
They really did.
Yeah.
But when you dig into the details, you see this clash between operational success fundraising is through the roof and some lingering complexity around valuations.
Right. So our mission today is to unpack that disconnect. We're going to look at a record-breaking fundraising year, a massive M&A spree, and we're going to open that black box of how they value their private equity funds.
Which was definitely the elephant in the room on the call. And stick around, because the strategy they're using in Brazilian real estate, it gives us a really interesting setup for our not financial advice segment.
I can't wait for that one. But first, let's hit the results snapshot. Give us the headline numbers. Did they make money?
They did. So let's start with the one shareholders care about most. Distributable earnings, or DE, they came in at 50 cents per share for Q4.
And the street was looking for what?
Roughly 46 cents, so that is a 9% beat. In this world, beating by nearly double digits is a very solid margin.
Okay, so they beat on the bottom line. What about the top line? I saw some chatter about a miss there.
That is where it gets a little murky, and probably what triggered some of the algo trading. Reported revenue was $123.79 million.
Which was a slight miss.
A slight miss.
Oh.
But the more dramatic number, if you look at their fee revenue, that was down nearly 36% year over year.
Ouch, down 36%. If I'm a computer reading that headline, I'm hitting the sell button immediately.
Immediately. But for a human investor, that number is, well, it's a bit of a red herring. You have to understand asset management accounting is, let's call it, flexible.
Right. The much more important metric here is FRE, fee-related earnings.
Exactly. That's the engine. It's the steady paycheck the company gets just for managing the money before you even worry about investment gains.
So how did the engine look?
The engine is humming. FRE hit $64.3 million, which is up 17% year over year.
Okay, that's strong.
But the metric I really liked was the margin. Their FRE margin expanded to 63.6%.
Let's pause on that because that number is wild. A 63.6% margin.
It's massive. That basically means for every dollar of fees they bring in, they're keeping nearly 64 cents as pure operating profit. It shows incredible operating leverage.
So the engine is efficient, regardless of what that headline revenue number says.
Highly efficient.
And for the income seekers, they declared a dividend of 15 cents per share, payable in March.
Right. But let's be honest. The number that really jumped off the page wasn't the dividend.
No, it was the fundraising.
Absolutely. This was the showstopper.
Mm-hmm.
They brought in $7.7 billion in organic fundraising in 2025.
And just to frame that, their target was $6 billion, right?
Correct. They completely crushed their original target. And remember, this is in an environment where capital raising has been really tough globally.
So let's dive deeper into that. Part one, the fundraising machine. $7.7 billion is a lot of cash. Where is it coming from?
Not where you'd think. I mean, the biggest driver was actually infrastructure. They raised $2.3 billion just for infrastructure strategies.
$2.3 billion.
Led by their Infrastructure Fund 5. And get this, that is 5 times what they raised for infra in 2024.
5 times growth in one vertical. That's explosive. What is driving that specifically?
It's a flight to safety and yield. You have global investors, pension funds, sovereign wealth. They're looking at the world and seeing volatility.
And infrastructure is a hard asset.
Exactly. Toll roads, power lines, data centers. These things generate cash flow whether the stock market is up or down. Patria is basically saying, come invest in the backbone of Latin America, and the world is saying, yes, please.
So they are selling stability. What else is working?
We also saw records in credit, which brought in $1.8 billion, And their global private market solutions, or GPMS, that brought in nearly $2 billion.
And the client mix is shifting too, isn't it? This isn't just family offices anymore.
No, exactly. We are seeing larger institutional checks. Geographically, they are overperforming in Latin America, the Middle East, Asia, but, and this is a crucial but, they are still underperforming in the United States.
Which explains the shopping spree.
It totally does.
Let's talk about that inorganic growth. They aren't just raising money, they are buying companies. It felt like every other sentence on the call was a new acquisition.
It's a very aggressive M&A strategy. They are trying to transition from being a LATAM manager to a global solutions platform.
So what's on the list?
Well, they close on Solis in January, which adds huge scale to their Brazil private credit business, about $3.5 billion in AUM.
And they bought RBR for the real estate side.
Right, adding real estate investment trusts, REITs. But the most strategic move was the announcement of WP Global Partners.
That's the U.S. one, right?
Yes. WP Global is a U.S.-based manager. It only adds about $1.8 billion in AUM, which on the surface is small potatoes for Patria.
So they aren't buying it for the assets.
No, they're buying the Rolodex.
They're buying distribution.
Exactly. They have incredible products in Brazil, but they lack the sales force to sell them to mid-sized American institutions. By buying WP Global, they effectively bought a pipe into the U.S. market.
So the strategy is, we have the products, now we buy the sales force and the relationships in the U.S. to sell them.
Precisely. It's a classic distribution play. But, you know, M&A is messy, and the market usually hates the we'll fix it by buying it strategy until it's proven to work.
Okay, let's unpack that elephant in the room then. Part 2, the black box of private equity valuations. The CEO, Alex Say, spent a lot of time on this. It felt a bit defensive, honestly.
It did, and for good reason. There have been questions swirling about their older PE funds, specifically Fund 4 and Fund 5.
These are older vintages, and they haven't been performing as well.
Right. And investors get nervous that the values of the companies in those funds are marked too high on paper, and that a big write-down is coming.
The dreaded mark-to-market bomb. But Alex laid out a pretty specific defense.
He did. He explained they use independent appraisers annually, you know, the standard stuff. But he made this one critical distinction that I think is vital for the stock.
What's up?
Patria does not charge management fees on net asset value, or NAV, for these funds. They charge on cost.
Okay, let's pause and make sure we get this. This is the deep dive nugget. Explain it like I'm 5.
Okay, so in the normal NAV world, you pay your manager a percentage of what your portfolio is currently worth on the market. If the market crashes, the manager gets paid less.
Makes sense.
Patria doesn't do that for these funds. They charge based on the original money you gave them to invest. So if you gave them $10 million, they charge their fee on that $10 million.
So even if the market value of those investments drops to $5 million temporarily,
they still charge you on the original $10 million.
Wow. So from a shareholder perspective, if you own PACX stock, your revenue stream is protected. It's a safety valve.
Exactly. The underlying performance might be struggling, but the management fee revenue, that steady stream we love, doesn't shrink. It puts a floor under their earnings.
That is a huge safety net. But what about the upside, the performance fees, the carry?
Well, that's the bad news. Fund 5 is currently out of carry. It's not generating those performance bonuses.
But since they never booked that money in the first place?
There's no write-down. This is where their conservative accounting actually helps. Some firms will book unrealized carry, basically counting their chickens before they hatch.
Patria doesn't.
They only book the fee when the cash hits the bank. So because they never promised the market that money, losing it doesn't create a hole in the earnings. It just means there's no cherry on top for a while.
So the summary is, the base fees are safe, and the performance fees aren't creating a liability because they were never booked. It's disappointing, but it's not a disaster.
Exactly. It's a what you see is what you get situation. Boring, but safe.
Speaking of safe, let's pivot to real estate. You usually think high rates kill real estate, but Patria is raising money hand over fist in their REITs. What is going on there?
This is where we get into macroeconomics and a really fascinating bit of human psychology. First, the macro. Brazil is on a different cycle than the U.S. Interest rates there are expected to decline in 2026.
Okay, so they are front-running the rate cuts. Investors are trying to get in before the prices jump?
Yes. But there is a fascinating detail from the call about who is investing. They call it the asset exchange strategy.
This was the part about the wealthy families, right?
Yes. Think about it. A lot of wealth in Latin America is held in physical assets buildings, land. It's tangible, but it's totally illiquid.
And Patria is going to these families and proposing a swap.
Exactly. They say, give us your office building, we'll put it into our REIT. In exchange, we give you shares of the REIT.
Why would a family do that? They love owning the building.
2 words. Inheritance planning. Imagine you are a patriarch with 3 children and 1 office building. When you pass away, how do you divide that building?
Poorly, you get lawsuits, fights, a disaster.
Exactly. But if you swap that building for 3 million shares of a REIT,
You give each kid 1 million shares. Done.
clean, liquid, divisible. They are seeing massive fundraising volume driven purely by this generational transfer of wealth.
That is brilliant. They are leveraging family drama to grow their assets under management.
It is. And it means they can grow, even if the macro is sluggish, because the motivation isn't just yield, it's peace of mind.
I love that. Okay, so let's look forward. What is the guidance for next year?
They're keeping a steady hand. They reconfirmed their 2026 FRE guidance of $225 to $245 million.
And long term?
Big goal. Hitting $70 billion in total AUM by 2027. They are currently at about $52.6 billion.
That's a steep climb. 18 billion in 2 years.
It is ambitious. It'll be a mix of organic fundraising and more acquisitions. They also announced more share buybacks, another 3 million shares.
And we have to mention the personnel change. The CFO, Anna Russo, is stepping down.
Right. It was presented as very amicable. The replacement is an internal partner, Rafael Denadai. It signals continuity, not crisis.
And quickly on performance fees, is anything coming in to save the day?
Infrastructure Fund 3. That's the golden goose for 2026. They expect about 19 million in net accrued carry to hit from that fund. So infra is carrying the load.
Pun intended. All right. Which brings us to my favorite part of the show, the part where we take the dry facts and spin them into something creative.
Here we go.
This is not financial advice segment. Please do not do this. But if we are pitching a trade, here's what it would be. I call it the Copacabana Succession Swap.
I like the title. Sounds like a spy novel. What is the thesis?
Okay, 3 facts. 1, wealthy Brazilian families are swapping illiquid buildings for liquid Patria REITs. 2, the Brazilian central bank is likely cutting rates. 3, global capital is scared of U.S. commercial real estate.
Okay, I follow the logic. What is the trade?
It's a geographic liquidity arbitrage.
Eh.
You go long Patria, PACs, you are using them as a leveraged play on Brazilian yield compression and that family consolidation trend.
Okay, long packs. What is the hedge?
You short U.S. office REITs.
Ooh, that is aggressive.
Think about the contrast. In the U.S., return to office is stalling. Vacancy rates are high. It's a secular decline. In Brazil, you have a secular inflow of assets because of that inheritance dynamic.
So you are betting on the old money preservation instinct in the South and betting against the work-from-home culture in the North.
Exactly. You swap the dying asset class for the consolidating one. You neutralize the real estate exposure and just isolate the geographic difference.
That is actually wildly plausible. You get paid to pay X dividend while you wait.
But again, absolutely not financial advice. Just a way to think about the data.
It is certainly creative.
All right, let's wrap this up. What is the final takeaway?
For me, the headline is the disconnect. The market penalized the stock because of a revenue headline and anxiety about old PE funds. But the business, the fundraising machine, is accelerating.
The signal is the fundraising. The noise is the revenue accounting.
Precisely. The risk now is execution. They've bought a lot of new toys. Now they have to integrate them.
That's the watch item. If they can make that U.S. distribution pipe work, this is a very different company in 2027.
Agreed.
That's a wrap on this deep dive into Patria Investments. Remember, the numbers only tell you what happened. It's up to you to figure out what happens next.
Do your homework.
Thanks for listening to Talk Tickers. Don't touch that buy button until you've done your own research. We'll see you next quarter.